In our last video, we talked about building a disciplined portfolio. But let's be honest, even the most carefully designed plan is useless if you can't stick to it. The single biggest threat to your long-term wealth isn't a market crash or a bad investment. It's oftentimes the person you see in the mirror. As a business owner or successful professional, you're used to making logical decisions. But the market has a way of turning even the sharpest of minds into emotional reactors. Today, we're going to tackle 3 of the most common behavioral mistakes investors make and provide a framework for how to avoid them. By recognizing these traps, you can protect your portfolio and stay on the path to achieving your long-term goals. Behavioral finance has identified countless biases that hurt investors, but 3 mistakes consistently stand out. This is the most common mistake. It's the tendency to buy what's hot and sell what's not. In our last video, we talked about the outsized performance of the Magnificent Seven. Investors who chase performance often over-concentrate their portfolios, buying more of what has already done well. They fall victim to the belief that recent performance will continue, even though decades of data has proven otherwise. The solution to chasing performance is a disciplined rebalancing strategy. This is a rule-based approach that forces you to do the opposite of what your emotions tell you to do otherwise. When an asset class, say large cap stocks, outperform and grow beyond its target allocation, rebalancing forces you to sell the winners and buy the laggards. This is a simple mechanical way to execute the classic buy low, sell high strategy, all without emotion. As a successful professional, you're used to controlling most of your professional outcomes, but you can't be the CEO of the entire market. This illusion of control often leads to excessive trading, market timing, and an endless cycle of buying and selling that racks up fees and taxes. The antidote is embracing a passive, long-term philosophy. Instead of trying to predict which stocks will outperform next month, we build a portfolio that owns large portions of the global market. This passive approach removes the pressure to be right about the future. Your goal shifts from beating the market to capturing the market's long-term rate of return, a far more achievable and sustainable objective. This is a subtle mistake that can have significant consequences. It happens when you don't stick to your plan. Over time, an asset class that performs well, like stocks in a bull market, will grow to represent a larger portion of your portfolio. Your risk level naturally increases even without you making a decision. Conversely, in a down market, your exposure to fixed income might grow, making your portfolio more conservative than your goals require you to have. The solution to portfolio drift is to rebalance, like I mentioned earlier in this video. But how do you go about doing that? This is done with your investment policy statement. Your strategic asset allocation, which is the precise mix of stocks, bonds, and other assets you own, is not a suggestion, it's your blueprint. We review and rebalance your portfolio on a predetermined basis to ensure it always aligns with the risk and return characteristics we define in your investment policy statement. This disciplined process ensures your portfolio structure never drifts too far from your intended path. Ultimately, the best defense against these mistakes isn't to be a genius, it's to be disciplined. It's about building a framework that removes emotion, focuses on the long term, and positions you to succeed over the lifetime of your investing. If you recognize any of these behaviors in your own investment strategy and are ready to put an evidence-based plan in place, I invite you to book a complimentary 30-minute introductory call. We can discuss a strategy that helps you avoid these common pitfalls and build a portfolio designed to capture the market's long-term rate of returns. You can schedule that call by clicking the link in the description below. And remember to subscribe so you don't miss the rest of this series, as well as the other series that we have on investment and personal finance philosophies for business owners and successful professionals. Look forward to seeing you soon.